Now, let's see which makes more sense to our next guest, David McAdams. David is president of McAdams Group, LLC, based in Memphis, Tennessee. He's known nationwide as a highly sought-after speaker and financial educator, and he shares his insights and advice frequently on magazines such as Forbes, on the radio, and in other financial media outlets. David, welcome back to the show.
Hey, thanks for having me back.
So, we've known each other for a long time now, and although we haven't talked recently about what's going on in the markets, and you just heard John Nigerian, who said that there's some positives, some negatives that worry him, but overall, he thinks with the economy going that the positives should outweigh the negatives for at least the next year or two in the markets, extending this bull market rally even further. What's your take?
He probably has a good point in the near term. I mean, frankly, with where we are with interest rates, the concern, of course, is if the Fed pushes interest rates higher in the near term, that we could see a flattening of the yield curve. If they push interest rates up too fast, too soon, then it's likely that banks would decrease their lending, which could force a recession. So that's where there's a lot of uncertainty there, because if that happens, I would tend to be in the more bearish category. What he's talking about is the next year or two. Of course, we've got kind of a strong tailwind with some of the economic policy change with the new administration in force. And the question is, how much longer can that go before the levee breaks? I kind of agree with you with your commentary in your monologue that we have seen such bull market rises in such a short, fast period of time that I really wonder if that would have happened without the stimulus package that the previous administration put into force, and really without what's famously called the Trump bump and the tax law effect and the economic policy from the new administration. I doubt you'd see market prices where they are today. So are we at a tipping point? I think you really have to keep an eye on those interest rates, because that could signal the next recession if they go too fast, too soon.
So the Fed's in the driver's seat to some extent, and people on Wall Street always say you can't fight the Fed. I know you've heard that a bunch of times. Dave, Sure. Stay with us. We're going to be back. You stay with us too. We'll be right back here on The Income Generation. Welcome back to The Income Generation. You're here with David Scranton and my good friend David McAdams from Memphis, Tennessee. So David, it sounds like you're saying there's a little bit of a carryover from all the quantitative easing that's helped us, maybe even some of the quantitative easing in Europe that John and I had spoken about. Also the optimism from the Trump bump. But you have a strong background in tax. You're a CPA by trade. So how much do you think the tax cuts are helping to spur GDP growth, and how long do you think that could last?
That's a great question. And actually, I actually thought before they passed the tax law that some of the earnings in the S&P 500 from 2017 probably already took that into consideration, because there was high optimism that the Tax Act was going to pass. And some people argue that it was already baked into the valuations. I mean, the valuations are very high today. They're very rich. It doesn't mean that there's not room for upside. I mean, frankly, as you know, back in the 1990s, as a price to earnings ratio, I mean, stocks have actually traded at higher values than they are today. Sure. I think the Shiller PE ratio, which is kind of a moving average price to earnings ratio, is somewhere in the 30 to 32 times earnings range. Now, having said that, stocks are getting rich.
According to Shiller, the only time that ratio has been higher was in 1929, which is also an interesting statistic.
Right. And so, I really think a lot of the valuations were already baked into the Tax Act. You've seen massive volatility this year. We've seen several downturns of greater than 5, 6, 7% already in 2018. We're pretty flat at this point during that period when you consider all the downturns and recoveries. Sure. So I really think a lot of that was baked in. I'm not expecting a lot of upside potential just based on the tax savings. But of course, they're working on other economic policies that could impact stocks positively. It just depends on how the political environment plays out.
So in the 30 seconds or so we have left in the segment, tell our income generation members then, what do you think is going to fuel the optimism over the next year, year and a half to get that short-term bump before things come back to normal again? Do you think maybe that the trade war will turn out favorably, maybe a few more quarters of 3-4% GDP growth before things get back down the twos? What do you think are going to be the biggest drivers?
I do think you're going to have to see continued GDP growth. And as far as the trade wars, President Trump said when he initiated and started down that path that you're probably going to have some short-term pain, but he was going to work hard and negotiate things that would be in favor of our domestic stocks and our economy. And so I think if he continues down that path, we will see positive events. The biggest issue, though, is how long can that keep pushing
How long can
up?
it go, right? Because we're already 9.5 years into a short-term bull market. It's near a record. How long can it go? I agree completely.
As you said,
Dave, so unfortunately, we got to leave it there for today. I apologize. We got to take a commercial break. Stay with us. We'll be right back with more here on The Income Generation.